we've started to get earnings on some of the names, and the two big names that we do own. They reported this week were EOG and Diamondback. And EOG, as you know, we're overweight. And Diamondback, we've got a sort of market weight position in that name. The key thing that both companies said is that they plan to keep their oil production flat at Q4 levels. So, from the macro standpoint, these companies in the US continue to look to maintain their oil production flat while returning all excess cash flow to shareholders in the form of either share buybacks or in the form of dividends, which in the case of EOG, they're returning 100% of their free cash flow back to shareholders. Diamondback, they're returning something just under 70% as they continue to pay down debt. But as far as the results in the quarter, they were sort of in line. There was no big beats, there was no misses. Everything was sort of middle of the road. Better. They always say, well, we beat the midpoint of our guidance. Okay, so it was still within the guidance range. Um, but at the same time, they continue to expect reductions in costs. We continue to see efficiency gains on the drilling and completion operations, which continues to add value on the bottom line and the returns for these companies. So for these names, I continue to hold them. The one thing I'm looking at, I've talked about this before on EOG, is I'm looking to, particularly if these pull back here, maybe lighten up a little bit to add to Devon. In other words, I want to shift a little bit of my weighting, my overweight position in EOG over to Devon, just to kind of balance out the portfolio and having more of a mix in Devon, which I didn't own before the recent acquisition, but I've been nibbling at that and just sort of moving some of the EOG shares over to Devon just to be more balanced here. But in the meantime, we've got some more companies to report here still, but that's sort of where we are on the names. The names are pulling back a little bit today, just on oil not running up. It's sort of holding flat here. I would say on natural gas, it's going to sort of bounce around $3 here until we get into the summer. I mean, for all practical purposes, the winter's over. We're heading into the shoulder period, so now we're looking ahead to what summer weather and demand is going to be. The one thing I would point out on these names is, particularly for those in the Permian Basin, like a Diamondback, is we're still waiting to hear if they ink some sort of big deal with data centers, which will occur at some point. When, I don't know. But remember, the important thing about the Permian Basin is you've got all this stranded gas for now that you're not getting a very good price for. You're making all your money on the oil. The gas, you're sort of just trying to figure out how to get rid of it because there's not the pipeline infrastructure to sell it to any market that you can get a decent price for. But because of that, at some point, you're going to see data centers probably locate or contact for that gas in Texas, where that's a cheap source of energy for these data centers. And you've also got water in a lot of these places too that they need to cool for cooling purposes for these data centers. And Diamondback mentioned that. They said they're not going to announce anything until the deal's absolutely done. But that could be something very positive for creating higher value for that sort of stranded gas for these companies at the point that they're doing some deals with data centers, which they will do. We're just waiting to see when and where and what these deals are. But there's upside for these companies like Diamondback and EOG and others that are in the Permian Basin in getting greater value in the future at some point for the natural gas that really they're not getting much value for today. And I think the market's sort of not giving credit to that yet, but it's just something that's out there. There's a little bit of upside on top of everything else. So we continue to own EOG, lighting up a little bit to buy more Devon, continue to own Diamondback, and then the typical names we talk about, C&Q, Chevron, Exxon.
All righty. So one of the comments yesterday after the president's speech was that sometimes what's not said is the most important. Do you think that his comments about Iran were helpful to oil prices, hurtful to oil prices? Does it mean, I just looked at while you were speaking on Polymarket, $44 million has been placed on a February 28th strike that, and mostly to the no side, because it's an 11% chance that it happens. And then, but when you go to March 31st, it gets to a 61% chance that there's a strike by then. Was there anything in the speech that kind of made you go, that's an interesting comment, or the lack of comment?
Well, I'm looking at Polymarket. It says by March 15th, about a 50% chance that the U.S. strikes Iran by March 15th. I think Trump's comment didn't really sway it one way or the other, but if anything, sort of kind of maybe dampen expectations on the upside of oil in the sense that he said, well, we're hopeful to make a deal. he leaned more toward the positive or the optimistic side that the U.S. can reach a deal with Iran. And he keeps saying, they want to do a deal really badly. So I think, if anything, you could interpret those comments as, well, maybe he doesn't attack, but he still might. I mean, he's very adamant about what he does want in a deal. So we're waiting to see. And we know that, history with Iran is they sort of talk the talk and try to skirt the issue and, sort of say, oh, yeah, we got a deal, but we really don't. They continue to enrich their uranium and continue with their program to the extent they can. The one thing we do know is the big issue in debate coming out of the State of the Union address last night is, what about affordability? That's going to be the issue going into the midterms. And as we've talked about before, one of the biggest things Trump can do to help affordability is get energy prices down. So at the end of the day, he wants one, regardless of the outcome, he wants the optics of a success with Iran and getting a deal with Iran, and subsequently, with everything that's going on, getting energy prices down. I think, the top among his top three things that can help the Republicans in the midterms and address the affordability issue is to bring energy prices down. So whatever the outcome, we see here ultimately, whether the U.S. attacks Iran or not, subsequent to that, he wants to see the oil flow. He wants to see a deal either where they agree to what he wants and the U.S. is able to lift sanctions and you see that oil flow into the market, which would be incremental supply, or the other end of the spectrum is he attacks and wipes out anything and everything that might look like a nuclear facility or enrichment capability, and then cleans everything up. And whether there's regime change or not, hopefully that he hopes then the oil flows in that scenario too. But however you look at it, the outcome he wants to see ultimately is lower energy prices.
Got it. All right. Well, just briefly on healthcare.